right. So I saw you guys discussing the textbook and all the fun stuff with regards to Wiley. Now, with the Wiley assignments, do make sure to log into the correct Wiley code. I have posted the Wiley flyer and the PowerPoints for that. So make sure that you log into the correct one and do take a stab at those Wiley assignments before they are due. Once the assignments close, they close. No matter what the reason is, they're not going to be reopened under no circumstances. It just does not. Okay. I have taught this course for very many years, and we have never ever gone back and opened the assignment, no matter what the reason is. Okay. So they do have staggered due dates, so do make sure to go ahead and attempt that. Now, when you are doing your Wiley assignments, just aim for 90%. Anything over 90% will be rolled over to 100. So once you hit 90, just move on to the next one. All right. It's entirely your choice. I mean, if you want to keep repeating it and then, keep practicing it, then that's not a bad idea. But as far as the marks are concerned, anything over 90 will be rolled to 100. Now, the cutoff is 90, not 89 and a half. Okay. So anything over 90, we'll roll it over, but anything under 90 is going to be what it is. Right. Now, you do want to make sure to dig your schedules to make sure that you have enough time to practice these problems. Accounting is not spectator sport. You can't win this just by watching us do it or somebody else do it, or even just by listening to the lectures. It's just not going to work that way. Okay, so do make sure to find the time to practice lots. And if you need any help, guidance, support, then feel free to email me. If you have any questions you want to talk before class, just again, I'll be happy to support if I know that you need it. All right. So just feel free to reach out and then we can make arrangements from there. All right. So that is that. And do make sure to attend your labs. All right. So getting into chapter 2. So we are going to talk more about our financial statements here. So once again, guys, some of you guys were concerned about reviewing the chapter material ahead of time. Yes, that's a very good idea, and you want to do that. You want to review the PowerPoints that are posted. I'm just going to go back to the Blackboard so that I can show you in case somebody came in a little bit later, like me, for that instance. Where is my Blackboard?
I'm sorry, I had another question about Wiley. So it says that the assignments are out of 15 points, but is it multiple questions that you're being asked to achieve a specific score?
I'm pretty sure that's the case, but I haven't looked at them off late, so don't quote me on that. I would go with whatever is in there. But
Okay.
I'm sure because the questions usually have the subset. First calculate, say for example, something like this. Okay, so they are all interrelated. And you could end up seeing the multiple choice as well. So Liam is saying it's usually multiple choice questions. All right, so this is what I was going to show you guys on your Blackboard. So these, the Excel that I'm showing you or working off of, so this Excel, they are all posted here under in-class problems from chapter 1 to chapter 14. Okay, so everything that you're going to need for accounting 21-21 in this semester, and the PowerPoints that I'm working off is here as well. They are all under Content tab. So make sure to review that information before. Try to take a stab at those questions if you do have the time before. If not, then we'll just do it in our time together. Okay, if you do find the time to take a stab, then you would know what's working, what's not working, what doesn't make sense, and why. Okay, so then we can focus more on that. All right, but at the least, once I start posting the lesson notes, the video recording of the, not the video, sorry, the audio recording of the lesson notes, then you want to make sure to review those absolutely must before the class, because we will not be going through that actual coverage in class then. We will just focus on the examples. Alrighty, coming back to our Chapter 2. So we are exploring the classified balance sheet or your statement of financial position. So this is the same financial that we were looking at in the earlier example. So, okay, sorry, there is a question that popped up. Oh, okay, you guys are talking about something else. All right. Okay, so for your statement of financial position, also called as your balance sheet, as we said, it looks like a T account. I'm just going to pull up my skeleton here. So on the left-hand side, we have our assets. On the right-hand side, we got liabilities and equity. These are three major sections of your statement of financial position or balance sheet, whatever you want to call it. Okay. Usually, the distinction is that if it's called balance sheet, then the company is a private corporation. If it's called a statement of financial position, then we are referring to a IFRS company or a publicly traded company. Okay, so that's the distinction. Now, asset is something that the business owns. Remember, we were just talking about that before the break. So, asset is something that the business owns, something that the business is able to decide on how to use that asset. For example, your cash. Cash is an asset. You have it available and you can spend it. So when the company is looking at a transaction, they have to determine who controls that item. Do you have control over that? When I say, okay, I have a car, right? Is that an asset? What do you think? I have a car. Do I have an asset?
Yes.
If you bought it, yeah.
Okay, so somebody said yes, and then somebody said if I bought it. What if I didn't buy it?
It's a liability.
Interest will be liability and asset will be a car price.
Okay, fair, right? So in accounting world, it always depends on what else is going around your transaction. So just because I have a car does not make that as an asset for me. It really depends on what are the, what is the other information around that transaction. Do I own this car? If I own it, then I should be able to decide how I want to drive it. If I want to drive it, do I want to burn that asset? Do I want to donate it? Do I want to sell it? I should be able to do what I please with my asset if I have the rights to that asset. So in accounting world, asset is something where you have rights to something. Okay. It's not the physical presence of an asset. It's the right or the ability to do something with that right. Okay. So it's a bit technical when it gets to that. So if I have the car, physically I have it, it does not make it an asset. Let's say that car was financed, which means I still don't have title to that. It is still with the leasing company. So that's not an asset. So the physical presence of an item does not mean that it's an asset. It's only an asset if I own it and I can do whatever I please with that asset. Right? On the other end, liability is something that you owe. You owe it to other people. Okay? So we'll talk a little bit more about liabilities in a bit, but let's just stick to our asset right now. Okay, sorry, I was just looking at the chat function. Okay, so there's nothing there. Okay, so now when it comes to your asset is broken down into different categories. There is a category for current assets. There is a category for property, plant, and equipment. We call it PP&E. And then there are intangibles. This is all that you guys would have to worry about during this course. I have listed the other ones just in case if you are looking at financial statements of any other businesses. Okay. There are other assets such as investment or industry specific assets. All of them are assets. The business has the rights to these items. They can do whatever they want with these items. Okay. Now, once we have different categories, then how do we slot them in these categories to say what's what? Why is cash a current asset and not a long-term asset? Okay, so the way we look at that is anything that is expected to be used up within 1 year from your last financial statement date is considered as current. The ability to do that, okay, whether you do it or not, it's a different question, but the ability for you to use up that asset or use it up within the next 12 months from your last financial statement date is your operating cycle. So that is what determines whether this is current or not. So cash is available right now. So if the company wants to spend it today, they can spend it today. Nobody's going to stop them. It's their cash. Okay. So coming back to the earlier slide, so your current assets are things that are expected to be used up within the next 12 months from your last financial statement date. Okay, your accounts receivable, you are expecting to collect that. You're not going to wait for your customers to pay you after 12 months, right? That's a long period. Generally, we expect them to pay in 30 days, 60 days, or maximum of 90 days. Okay. Inventory, what is that? Any idea what inventory is or what supplies are?
If if you're a t-shirt company, then the amount of stock of t-shirts you have is your inventory.
Okay.
Like pencil on a table in office, it is basically an asset, should be. Something like that, right?
Yes. So, your tables and chairs, they are an asset for sure, but they are not your current asset. And we'll talk a little bit more about that just in a few minutes there. So, inventory, guys, is something that a business produces to sell to make money. All right. So, I work with a mining business and we we mine, not manufacture per se, but we mine silica sand. Okay, so that is our inventory, something that we are, preparing, manufacturing, mining, whatever you want to call it, in order to sell to make money. That is inventory. The intention attached to inventory always is to sell and make money. Okay, so if you have lots of t-shirts that you are expecting to sell and make money off that, then that's your inventory. On the other hand, your supplies is something that you are using in the course of your business to generate revenue. Okay, so your pens, papers, staplers, erasers. Okay, so those kind of ancillary stuff that you use, because you can't just revenue just doesn't generate by itself. Somebody has to do it. There is a work, there is a process, right? So whatever office supplies we use in order to generate that revenue is your supplies account. Okay.
I have a question
So.
about inventory.
Uh-huh.
But what is it based on? On your buy price or on your sell price? For example, a t-shirt company, yes? Let's say you're reselling basically t-shirts. So you bought them for $100 each, but you're selling them for $120. Are we counting $100 or 120?
Does anyone want to jump in here? So if your cost is 100 and you're selling it for 120, how much is your inventory worth?
Yes, exactly.
$20.
No, that's your profit.
Profit, right? Inventory would still be worth.
I mean, your profit's $20, but if you're selling it for $120 per unit, it's worth $120 per unit. Just because your cost is only 100, when you're thinking about that, you're getting confused with margins and stuff, I believe.
But then,
No. Okay, sorry, go ahead.
But then, never mind. No.
Good discussion, guys. Good discussion. And that helps me determine a level to pitch at. Okay, so okay, just to put this in perspective. So if you have your t-shirt, you bought the t-shirt for $100 and you want to sell it for $120. Now, your money that you're spending on your inventory is your cost. So if you have spent $100 on that t-shirt, whether you purchased it or you manufactured it, whatever the case is, your inventory will always sit on your books at cost. It always have to be at cost. That's one of the fundamental ideas with the inventory accounts. It has to be at cost. Now, keep in mind your inventory, the intention is that we are going to sell it and make money. All right. So onto your books, when you're looking at your income statement, I'm just going to go back here. So when you're looking at your income statement here, so you're saying I sold it for $120 and my cost was $100. So my income or the profit is $20. So that $100 is your inventory. All right. If you start moving your inventory at the selling price, then your income is always going to be a big fat zero, which is not what we want, right? Your income is the difference between the cost and the money you generated. So the cost was $100, but we sold it for 120. Your profit on that is $20. Does that answer?
Yeah, yeah, makes
Okay.
sense.
And we will talk more about inventory in the following chapters because that is again on a very conceptual level when it comes to inventory. Inventory actually is um, one of the biggest current asset accounts. Okay, in our business context, when for my business, when we look at the financial statements, our inventory can be as big as 40% of the actual current asset base, and sometimes even more. Okay, we have got millions of dollars tied into that inventory. So that account is huge. So there are lots of rules and regulations and what can be done and what can't be done with inventory. So yeah. Okay, so we'll just leave it at that for inventory. But on a basic level, inventory will sit at cost. And we have a couple of chapters down the line that we will talk about how to calculate the cost of inventory and what goes into inventory, so on and so forth, just because of that, right? So supplies is something that will get used within the course of business, but inventory is something that you would sell to make money. What is prepaid expenses? Prepaid expense is something that the business is paying for in advance, such as your insurance plan. Perfect, Patrick. Yes. Okay, so generally what happens is with the insurance plans, when the company gets insurance policy, the premiums on the insurance policy has to be paid for the whole year upfront. Okay, so that becomes a prepaid expense or anything that you are prepaying for. So it can be prepaid rent, it can be prepaid bills. I'm not sure. I've never seen anyone prepay their bills. Okay, because in the business world, we try to manage our incoming and outgoing cash. So I never prepay any bills, unless it's a necessity such as your insurance. In that case, we will. Otherwise, nah. All right. So prepaid expense is something where you have already paid for that item in advance, but you haven't used up the benefit for that. So it becomes a current asset. So anything in the section current, whether that is current asset or current liability, is expected to be used within 12 months from your last financial statement date. So Liam is saying some places give a discount for prepaying bills, but even having the option is rare. That is a different concept, Liam. Okay, so we will talk about discounts, and those are great questions. So just hang on to those ones. We will discuss and explore more about discounts when we go through the following chapters, because again, the discounts is optional. It's up to me to take it or not take it. So if somebody said, okay, pay me, generally you would pay me in 60 days, but if you pay me in 20 days, you can have 3% discount. That is up to me whether I want to take that discount or not. They can't force me to take a discount. So it's an optional thing. So we'll talk more about that in the following chapter. Okay, so that is your current asset. Now, anything that is not expected to be used within that 12-month time frame then becomes your long-term asset. So long-term assets are then broken down into different categories here. Okay, so your non-current asset or long-term assets are broken down into long-term investments, into property, plant equipment, intangibles, and goodwill. Okay, long-term investment is where the company has bought something. They are going to keep it for over 12 months from the last financial statement date. That becomes a long-term investment. Okay, let's say the company bought invested in some another business. They got the shares of another business. That becomes a long-term investment if the company intends to keep it for over 12 months. If the company intends to sell it quickly, then it will become a trading investment here. So it really depends on the intention and how the company classifies that, right? Then somebody was talking about the chairs and the tables being an asset. So are we all good with that being an asset?
Yeah.
Okay. And why is that an asset?
It's more than likely we bought it and we didn't lease or rent it.
Okay. Asset is something that is giving you some sort of a benefit, right? You have a comfy chair. I'm sure the benefits of that is immense, right? Especially in these days. Yeah, you know what I'm saying. Okay. So asset is something that provides you with some sort of benefit. Now, the distinction between current and long term is long term has to be over that 12-month window that we were talking about, right? Plus, the life of these assets have to be over a year. If any asset, if you're looking at tables and chairs, they're going to last you at least, let's say, 3 years. Okay, that makes it a capital asset, where that capital asset, your property, plant, equipment, or so to speak, is going to give you benefit for next 3 years while you are generating revenue. Okay, so it will, because your asset has physical substance, it will become part of property, plant, and equipment. So the two things that we look at when we are deciding whether your asset is property, plant, equipment, or intangible assets, those two sections are quite similar. So the two things that you need to look at is the life of my asset over 12 months? The answer has to be yes. Okay, if it's a no, then it doesn't belong here. So if the life of your asset, in this case your table and chair, the life of your asset is over 1 year, we said yes, it looks like it's going to last us at least 3 years. Secondly, is it helping you generate revenue? Okay, in our case, the answer is yes, because we are using those tables and chairs for the employees to use, and these employees are helping generate revenue. They have to do the work, and that's how the revenue is being generated, right? So that becomes a long-term asset. Because there is physical substance to your table and chairs, it becomes property, plant, equipment. If it was something intangible, such as a franchise or a patent or a customer list, then that becomes intangible asset. But the idea still remains the same. It has to help you generate revenue, and then the life of your asset has to be over 1 year. Okay, there are a little bit more nitty-gritties when it comes to intangible assets, but we will explore that down the line. For now, this is good. Okay, then we have a concept of goodwill. Goodwill is something that the company pays over and above the equity. So in the earlier chapter, we said, let's say you're buying a new business. What are you really paying for? What do you think? Let's say you're buying a business for $10,000. Let's just keep it simple. So 10,000 is what you're going to pay. And so what are you going to get? What are you paying for?
I mean, it kind of depends on what you're paying for. Like, say if you're a clothing company and you bought another clothing line for $10,000, you may get their assets, you might get their employees, their talent, but you might also be paying for future potential of the business and future business opportunity that you might get through that business.
Okay, so then to sum it up, basically you're paying for the balance sheet or the statement of financial position. Is that a fair statement then?
Yep.
Yeah, okay. And that always is the case. When you're buying a new business, what necessarily you're paying for is the equity. Remember, your assets equals liability plus equity. That means I'm paying for assets minus liability is my equity. So the $10,000 that I'm paying is really for my equity, which is the difference between assets and liabilities. Right? Now, if I'm paying $10,000, but the actual assets minus liability only works out to $9,000, but I'm still paying $10,000. Why is that? Why would that be? Why would I pay $1,000 more? Remember, I'm an accountant. There
Both
must
sides
be,
need to be balanced.
sorry?
Both sides need to be balanced.
Well, the both sides would be balanced as assets minus liability. The total worth I'm getting out of that business is only 9,000. So you're right. I would record the other $1,000 as the goodwill. But what am I getting? Why am I paying? Am I stupid to pay the $1,000 extra? No, not right. So when the business is already established, there is already customer base that is set up. There are vendor base that is set up. There is recognition. People recognize a business name. They recognize the product. Okay, so there is a significant amount of time, effort that have gone into that process. So when you buy an existing business, the business is already established. So what you're paying is for something that you can't put your hand on, but you know that it's going to add value. That something that you can't define is your goodwill. Generally, when the new businesses are purchased, you would end up seeing you would end up seeing goodwill. Sometimes, in a rare instance, there can also be a concept of negative goodwill, but we won't get into that. All right. So that is your assets. On the other hand, if we are looking at our, okay, sorry, before we move on to the liabilities, if you have a long-term asset, okay, such as your land, property, furniture, tools, computer, vehicle, whatever, machinery, whatever you have, okay, it's supporting your operations and the life of your asset is over a year, then you have to depreciate that asset over its useful life. So the process of depreciation or the concept of depreciation is allocation of cost of your asset over its useful life. So under IFRS, we call this term as depreciation when we are looking at property, plant, equipment assets, which is assets with physical substance. On the other hand, if you have an intangible asset, then we would refer to the same term as amortization. But conceptually, it's the same idea. Under ASPE, we often call this amortization. Okay. In my business, we actually call it depreciation. So really, for the ASPE businesses, they can practically call it amortization or depreciation. Either or is fine.
Good question for you on that. How so? One of the things that we just said was that intangible assets could be a customer list. How does a customer list? How do you account for amortization on that?
That's a good question. So it really depends. So when you're buying a new business is really not an easy process. Okay, so I'll give you my real life example. So our business actually, we have so just taking a step back. So our mining business, we have presence in Canada and we have presence in US. Okay, so our US division, in the last year and a half, 2 years about, we bought an existing business. Okay, a business was already set up in US in multiple states. It was going well, and they were looking to sell it. So we jumped ahead and we bought that business. So when you're buying the business, we ended up buying their assets. We also took over their liabilities and their equity. So basically, we purchased their balance sheet. Okay. Now, one of the things that was, so when we look at the total price that we paid, then we allocate that price between different assets. Now, they already had an established business, which means they had a customer list. They already had a working relationship with these customers. They had lots of them. And we took over all of those customers and the vendors. There is a lot of value in taking over those relationships rather than starting from scratch. So when we brought in a customer list as an intangible asset onto our books, we had to substantiate how we see this adding value and for how long will it add value. So there has to be some sort of a market analysis to substantiate that information. We just can't say, as a business, I can't say, well, I'm the controller, so I think it's going to add value for next 10 years. So let's just go ahead and amortize that over next 10 years. My auditors will not buy that, okay? Not 1 ounce of it. So I have to establish, how did I come up with that 10 years? How does that make sense? What is it based off? So we have to spend a significant amount of time in establishing that information. Often the companies end up getting third parties to substantiate that as well. Okay, so you can go with some market standards. So, and sometimes it's just a process of negotiation, frankly speaking, between the company and the auditor. So it's okay. So if you can sell it, then go ahead, sell it. Does that answer, Tarun?
Yes, that makes sense.
Okay. All right. Okay, so when you're depreciating your asset, this is what your asset will look onto your balance sheet. Your asset at total cost, whenever that cost was paid, this does not change, minus your accumulated depreciation gives you your net book value or the carrying value of the asset. Accumulated depreciation is how much of your asset was used from day one when you acquired your asset. Okay, so these are your intangible assets, such as your patents, copyrights, trademarks, licenses. Goodwill is an item outside of intangible assets. So you don't club it in the same section. So it comes after your intangible asset just as a separate line item. Goodwill, it doesn't have a life. Okay, so goodwill have to be tested for impairment to see if it still holds the same value or not. We'll talk about impairment in the later chapter, so if it doesn't make sense, don't worry about it, it's good. All right, so your liabilities. So asset is something that we own. On the other end, your liability is something that we owe. So your liability is something that has a past, present, and future. So there was a transaction in past. As of present, there is an obligation. And in future, whenever that obligation is settled, you will have to deplete your resources or your assets. Okay. The best example of that is my kids. I have two beautiful kids. I love them to pieces, but they're a huge liability. Right. So there was a transaction in past. We are not going to discuss that. As of today, there is obligation for me to keep paying. And as I settle this obligation, my resources, which is my asset, is going down. So there is a past, there is a present, and there is a future. So your liability, anytime you look at a transaction, it needs to have all three, past, present, and future. If it's missing any one of those, then it's not a liability transaction. Right? So liabilities are basically distinguished between two categories. One is the current liability, the other one is long-term liability. Current is anything that is expected or should be paid within 12 months from your last financial statement date. Long-term is anything outside of that 12-month window. So items such as your bank indebtedness, assuming that it is due within the next 12 months, makes it current. Accounts payable, this is the money that you owe to your vendors. So for your utility bills, your supplies, anything that you have purchased, that is your accounts payable. Deferred revenue is the deposit your customers gave you. So they have given you the money and you owe them the services. That's a current liability. Your bank loan or notes payable, if their term is 12 months from your last fiscal year end. Same thing with your current portion of the long-term debt. Your long-term liability is anything where your payment is over 12 months. So something as your bank loans or notes payable, lease obligations, pension funds or benefit obligations, and your deferred income tax liability. Now, all of these long-term liabilities are discussed in the future accounting courses. So for this course, we practically just stick to the current liability section. but it's still a good idea to know what are the basic elements that goes into it. We will still see them on our financial statements, but we won't get into too much details.
Guru, quick question. When we were going in the current liabilities, when we were talking about, like, say, prepaid rent, so the person who's providing that facility to the person who did the prepaid rent, the opposite of that would be then deferred revenue?
Yes.
Okay,
It depends on whether you as a business is receiving money or paid money. So
Okay.
if we as a business have paid for something ahead of time, then it becomes an asset for us because we have already paid for it but haven't used it. But if someone else is paying us, then we are liable to provide the services, which is deferred revenue. So you're right, it's exactly to the other end of the prepaid.
Perfect. Thank you.
Okay, so your shareholders' equity is made up of your share capital, which is your common shares and preferred shares, and then the retained earnings is just what is left in the business right from day one that the business started. So let's look at BE 2-1, and I did not this one, sorry. All right. So I brought the question here on the Excel. So in this question, BE 2-1, they have given us a bunch of accounts. So we need to determine where these accounts will go, to which financial statement and which category. So accounts payable. Accounts payable will go onto your statement of financial position or your balance sheet as a current liability. This is the money that we owe to our vendors, okay, such as your utility companies or the money that you owe for your supplies, so on and so forth. Not your employees. Your employees are not your vendors. Then we have accounts receivable. Accounts receivable is the money that we are expecting to collect from our customers, which makes it a current asset onto the statement of financial position or your balance sheet. Okay. Anytime you see current, the estimated collection or spent is within 12 months from your last financial statement date. Accumulated depreciation. Accumulated depreciation is a contra account to your parent. Okay, contra account is something that will deplete the balance of the parent account. So I always look at my kids as a contra account. Okay, so contra account, the whole intention of a contra account is to deplete the parent account. So they always are attached to something and they will always have a negative effect. All right. So if I'm making money, my kids are spending it. They are a contra account. Okay. So they will do exact opposite of what I do. So that's what a contra account is. So accumulated depreciation is a contra account to assets, and that goes as the property, plant, equipment, the long-term asset onto your statement of financial position or balance sheet. Your building is a long-term asset. It does have physical substance. The life of that asset is over 1 year, and it is helping business generate revenue because that's where, let's say, maybe the manufacturing plant is or the office building. Okay, either way, it is helping the business generate revenue. So it has to support revenue, and the life of that asset has to be over a year to make it a property, plant, equipment, or a long-term asset. It has physical substance, so it becomes property, plant, equipment. If it was lacking physical substance, then it will become intangible asset. Cash is the first and foremost current asset onto your statement of financial position or balance sheet. Okay, your assets onto your balance sheet are listed in the order of liquidity. Okay, so the most liquid is cash, so it comes first. Then comes your accounts receivable, so on and so forth. So they are listed in the order of liquidity, which means how quickly can you convert this to cash. Common shares. Where do you think that would go?
That being current liabilities.
Sorry, in the liabilities?
Current liabilities.
Current liabilities? No, Common shareholders are your owners. Remember, your shares, the shareholders are seen as the owners of the business. So your common shares will go as the in the equity section as the share capital. Okay. The owners are different than the lenders. Okay. So the owners own the business, but they're also taking risk in the business. If the business does great, then the owners will reap the benefits. But if the business does poorly, then it's the owners that are going to lose the money. Okay. But technically speaking, you don't have to give them a dime. The companies choose to pay out dividends to their shareholders, but they don't have to. It's a choice. Okay, so there is never a commitment in this relationship when it comes to the business and the shareholders. It's a perfect kind of a relationship where there is no commitment. It's all on goodwill. They can go ahead and do that or not do it. Entirely corporation's choice. Then we have current portion of mortgage payable. Because it is current and the mortgage payable is a liability, then it becomes current liability on your statement of financial position. Deferred revenue is the money that was given to the business by somebody else. So the business has the liability to offer the services or sell a product. Okay, so that becomes a current liability on your statement of financial position. So Anton is saying, why give dividend in the first place? Well, the companies that are, let's say for right now, the companies that are still paying dividend in COVID times, you might want to look at their share prices. They're doing really well. So their market capitalization is really amazing, right? So it's paying out dividend is always a good sign. So we'll talk more about dividends when we talk about corporations chapter. So the dividend that is declared, this item goes on to your retained earnings or the statement of changes in equity or the retained earnings section. See, this guy, let's see, let me show you the earlier example that we were looking at. This is the dividend they're talking about. So it goes under the retained earnings sections onto the statement of changes in equity. Income tax payable. Anything that is payable is a liability. That means you owe that money. Okay, so this is what you owe to the CRA, and they are not going to wait for very long for you to pay. So it makes it a current liability onto our statement of financial position. Inventory is a current asset on the same statement of financial position. Land. What do you think of that? Where should land go? Is that an asset, liability, equity, revenue, expense?
Property, plant, and equipment.
Property, plant, equipment. Okay, that is. Okay, now land is the only asset that does not depreciate in value. Any other asset that you have in property, plant, equipment has to be depreciated over life, but land does not depreciate. Then we have long-term investment. A long-term investment is a category in itself. Mortgage payable that is due in 20 years. Any payable is a liability. Then the question is whether it is long-term or short-term, because we are looking at 20 years time horizon, which is way over our 12-month cutoff. We are looking at non-current liability or long-term liability. Patent is your intangible asset. It helps businesses generate revenue, but it doesn't have physical substance. So if you get awfully upset with somebody, you can throw a patent at them. Okay, you can only swear at them, but you can't throw a patent. So it lacks physical substance. So that is one of the distinctions between property, plant, equipment items and intangibles. Prepaid insurance is when the corporation has paid for the insurance example that we were looking at upfront for the whole year. It becomes a current asset where we have paid the money, but we haven't yet realized the benefit. And same thing with supplies. Supplies is also a current asset on statement of financial position. Any questions so far? No? All right, so let's come back to that example that we didn't get through in chapter 1. So P1-7A. All right. So here we are, P1-7A. So we had a bunch of accounts that were presented here. We were preparing our statement of income statement, statement of changes in equity, and statement of financial position. Okay, so we can look at our skeleton here. So your statement of income will have your revenues and expenses. Your statement of changes in equity will have our common shares and retained earnings, which will include the dividend information. And our statement of financial position will have our assets, liabilities, and equity. Once you have your basic layout ready, then all we got to do is just go through these accounts to see where they would fit. So where do you think the cash account should go? Where on statement of financial position? Cash is an asset. What type of an asset is that? Current asset, property, plant, equipment, or intangible?
Current asset.
Current asset, okay. Your account receivable is also a current asset. What about accounts payable?
Current liability.
Current liability.
Liability.
Current liability. Bank loan payable for $23,000.
Current liability.
Liability.
It's a liability, but current or long term?
Depending on when you have to pay it off by the terms of the loan, probably more than 12 months, so long term.
Depends on the term of the loan. That's perfect. It really depends on what else is presented. Okay, so if it does not say anything, then we will assume that this is long term. If there was any indication that this would be paid within the next 12 months, then the same item will become current. So it really depends. So here we'll take that as long term because they haven't said anything.
So we
Common share.
always are assuming that something is long term unless otherwise specified, or is that just for bank loans?
Just for the bank loan tier. Because, okay, think of it this way. Let's say mortgage. If I said mortgage payable, what would you think? Just logically connect the dots.
Long term.
Long term, the same idea applies to bank loans. So it depends on the account type as well. Okay, so generally speaking, the bank loans, mortgage payables, these are the long-term liability accounts, unless there is something else going on and it specifies that there is a portion that will be paid in short term, right? Common shares. Common shares will go into your statement of changes in equity. Same thing with your dividend declared for $1,000. Your service revenue, supplies expense, they are your statement of income items. What about your supplies account? Not the supplies expense, but the supplies of $1,200. Where do you think that would go?
That's a current asset, no?
That's a current asset. Perfect. Equipment is your long-term asset, also called as property, plant, equipment asset. Interest expense, where would this guy go?
Current liability.
Mm-mm.
No.
Expense is not a liability. Okay, so the difference between expense, when the account name says expense, that means it's already been used up. Something that is used up, it's done. You have already squeezed the last, drop out of it. It's already been used up. It doesn't have any future benefit whatsoever.
So does that make it equity?
No, expense, remember, onto your, let me go back. Where is my Excel? Ta-da! All your revenues and all your expenses always go to statement of income. Expense is what you have incurred in order to produce revenue. So all your expenses will come to your statement of income. The only catch is sometimes if an account name is prepaid expense, then you would go by prepaid, not the fact that it says expense. That usually is just the trick there. Okay, expense is something that's used up. Liability is something that you owe and you have to pay in future. So entirely two different types of accounts. So office expense is also an expense on your statement of income. Same with utilities expense, income tax expense, and salaries expense. So once we have figured out where our accounts are going to go, then we just need to bring that information forward. So I brought the revenue on the statement of income in all of the expenses that we were just talking about. So these expenses were incurred in order to support the revenue. So total revenue of 24,200. Since we have multiple items in the expenses, always a good idea to show what our total expense is. You are expected to show this. Okay, so don't get too creative when it comes to the formats, just stick to the format. So your revenues minus total expenses gives you your income before taxes, minus your income tax expense gives you your profit or loss. With your common shares retained earnings or statement of changes in equity, we started with the beginning balances of zero. They didn't say anything, so we just assumed it's all zero because if there was anything, then they should have stated that. Okay, now keep in mind the ending balances in this period will become beginning for the next period, right? So common shares, there were common shares issued for 36,000 and that was given to us here. Common shares for 36,000, that's where it's coming from. The dividend declared for $1,000 was also given to us. So the dividend will reduce your retained earnings. What is this 11,900? Where did this come from? This number was not given. So how did I get that? From the income statement. Perfect. That number is this. Okay, whatever number profit or loss was calculated on your statement of income, it's just flowing through here to the retained earnings. Okay, so with the total equity column, we have just shown the total for each row. And we have done the same thing with your statement of financial positions. Once you determine where your asset belongs, we have just brought it to the correct category and we have shown the subtotal if there are multiple items. So our total current assets, which is a combination of cash, accounts receivable, AR is accounts receivable and its acceptable abbreviation, and supplies account adds up to 25,200. The equipment is $52,000. There was nothing for intangible investments or others, so we just left it blank. So we got total assets of 77,200. We did the same thing on the liability side. There was only one current liability, the bank loan payable. We assume that this is long term because the question did not tell us otherwise. So our total liability is a combination of current and long-term liability. Your share capital information, this 36,000 is coming from your statement of changes in equity. So that 36,000, retained earnings is 10,900, and that information is just brought forward. All in all, your total asset has to equal your total of liability plus equity. Any questions? No? Does this make sense?
Yes.
Okay. Alrighty. So we are getting quite close to 8:50. I suppose we should call it a day. We did intend to complete chapter 2, but we couldn't get to that, but that's fine. I'll just go ahead and post the recording for the rest. So do make sure to listen to the recording for the remainder of chapter 2, and I will post that for the following chapters as well. So for the next class, we will be wrapping up chapter 2, whatever is left of that, and we'll be looking at the examples, and we will be looking at the examples for chapter 3. If at all possible, we will start with chapter 5, but we'll see how that goes. We will, from next class onwards, we will start doing the examples in our time together. So in about 2 hours that we are together, we'll look at the examples. But all of this, so let's say from here, the conceptual framework, all of this material would be covered in the audio lessons that I will post. So do make sure to review those. Okay, this is just an example. I'll do the same with the chapter 3 and the other chapters as well. Any questions? You're very welcome, Liam. It does seem quite a lot to handle. So make sure to find the time to stay on top of that. Don't let this slide. If you just wait, if you just sit, think, you know what, by next week I'll figure this out, it's going to be late. Believe me, this course goes so fast and there's so much material in this. Once you start falling behind, it's kind of hard to catch up. So try to stay ahead of the curve. Yes, Manur, you can email me. So it's ggill@mtroyal.ca. So my first initial last name at mtroyal.ca. Very welcome, guys. If you guys don't have any questions, then feel free to call it a night. And thank you so much for tuning in. My sincere apologies for the snafu that happened earlier. It was just not, it's never happened to me. I'm not sure why my system glitched out.